Hello and welcome. You're watching KYC. This is a show where we focus in on a single NSE listed company daily. And today we're going to focus in on Dhanuka Agritech. It's a manufacturer of agrochemicals, largely sells products in India and across India. Now, in terms of what are agrochemicals, let's try and break that one down. So, one is, of course, it's a manufacturer, has 4 manufacturing facilities. Agri-chemicals are normally herbicides, insecticides or fungicides, and it also deals in plant growth regulators. That's the other piece it deals with, and it has products across the board where plant growth regulators are concerned, whether it's powdered products or whether it's to be sprayed on the plant to ensure that growth is healthy. In terms of revenue mix, and this will give us a good indication as to how the split is, it's a fairly healthy split in that sense, as you can see. Largely between 20 to 35% on each of those. So no real single product taking charge. And in terms of product variety as well, a very, very large variety is what Dhanuka caters to. 300 plus product registrations is what they have. They have 90 odd products across each of their segments, and their geography that they cater to is pretty much pan-India. It covers all major states and reaches more than 1 crore farmers across India. So clearly a good reach and a large product presence in that sense. Now, in terms of how the supply chain is like, and all the way from manufacturing to sales, you have 4 manufacturing units, one in Dahej where the capacity utilization is low. We'll try and zoom a bit on that particular metric as well. Raw material, some of it is imported from Japan as well as China, as you would well understand. That leaves it open both to supply chain as well as to currency risk. The other piece is where gross margins is concerned. They've done 35 to 40% largely on gross margins, currently trending more towards the 40%. So they're doing 38, 39 kind of 39% kind of gross margins. They have 41 warehouses across India currently, and they distribute their products to 6,500 distributors and over 80,000 retailers. All of those help push their products to over 1 crore farmers that they have tapped into. In terms of recent news, and this one is important because it opens up plenty of opportunities. They've acquired Bayer's key fungicides, and they have the rights now to market some of these fungicides. They have the right to manufacture, sell these ingredients, and currently Bayer manufactures some of these ingredients. Of course, this is maybe a couple of quarters back. They've acquired this now. And how does this aid Dhanuka? It's going to help Dhanuka expand globally, access to over 20 countries now, not just to Bayer's products, but even their own products currently. They're looking at expansion, Latin America, EMEA region, as well as Asia. And India, with regard to some of these new products which Bayer has sold to the company. Dhanuka's agreement will enhance its market positioning, and on a couple of those products, in fact, Bayer has nearly a 25 to 50% market share as well. It contributes around 220 odd crore to top line for Bayer. This is 2023 calendar year, and therefore in terms of overall top line as well, it contributes decently. It's a decentish kind of acquisition in terms of size. It's expected to boost both top line as well as bottom line. And we will also speak with the management of Dhanuka Agritech on KYC today. We'll speak to Mr. MK Dhanuka, who will give us a better perspective on everything that's happening. But first off, let's break the company down. Let's look at what metrics we look at when we're analyzing the company today. We'll look at, of course, the income statement, the cash flow, the balance sheet, as well as the return ratios, all 4 of those parameters. But along with it, we'll look at shareholding, street cred, outlook, and we'll really dive deeper into the valuation picture. The outlook will largely be governed by whatever we've been sifting through in terms of documentation and what management has been guiding for. So we'll look at all of that on the show today. And again, joining me today is Varsha, who will help us break this down. Of course, she tracks pharma as well as chemicals very, very closely and is our go-to on those sectors in any case. So I think we're well taken care of today. But Varsha, let me allow you to start with the income statement. It's a thumbs down on this count. So tell us what's happening here, why the sluggish growth?
So actually, if you see, if I were to talk about the revenue, so let's speak in terms of compounded annual growth rate. So if you see the CAGR, three-year CAGR for revenue has been 8%, followed by EBITDA, 3-year CAGR 7%, and net profit is the compounded annual growth rate is 5%. Now let's see what are the reasons for this. One is they faced challenges due to Nino conditions causing lower rainfall impacting farmers' demand in India. One reason is that, and also we all know what's happening with overall chemical industries that also includes agrochemicals. So global demand, if you see for agrochemical, was down due to destocking in US and Brazil, and also there was overcapacity and oversupply in India and China, leading to lower prices of generic molecules. So when the prices of the end product goes down, your realizations goes down, and that affect your overall sales for the company. And they also face challenges due to lower price of generic products and oversupply in the market. So they cater to rather two segments. One is the generic one and the other one is specialty one. So of course, there was this pricing war or pricing pressure going on when it comes to generic agrochemicals, and that's what caused them, that was caused the lower growth when it comes to sales. Now, for Q3 FY25, if I were to talk about, Q3 is actually crucial when it comes to rabi crops. However, low pest and disease pressure impacted their fungicide sales, and also there was carryover inventory from previous season, which resulted in lower commodity prices. And overall, so this was the reason why the 3-year CAGR numbers for the company were not good. But I also wanted to highlight about the margins front. So if you see in FY20, company had almost 15% of EBITDA margin. Fast forward to FY24, the margin stands at around 19%. Now, the improvement in margin that we are seeing from 15% to 19% is largely driven by their lifeline category, which is a specialty segment which has a higher margin. So overall, Harsh, this is the reason the ongoing pressure when it comes to agrochemicals, which was actually true for every other company present in agrochemical sector.
Correct.
And this is the reason why we are seeing the lower growth and hence thumbs down.
Yeah, and we've seen this even in case in point being UPL, Varsha. And we had a very interesting HSBC note today morning, which suggests that there's going to be a bit of a turnaround. But UPL, the worry was the debt.
Exactly.
Here, therefore, the balance sheet holds the key, because in down cycles, if you are caught with a lot of debt on your balance sheet, you will likely see a headwind with regard to your income statement, because you'll have a large debt and you'll have to service that debt through an interest cost,
exactly,
which will impact your profits. And of course, UPL was in the loss for quite a bit on the back of that. But let's look at the balance sheet, therefore. When we're looking at, in fact, the balance sheet picture, there you go. You're seeing reserves at healthy levels. You're largely seeing the book value to be around the 1250 odd crore number. But the short-term debt is what really is something that we'll have to look at, because there's no long-term debt on the balance sheet, which is very, very good. 57 crore in terms of short-term debt. There's also lease liabilities that I see. That's not exactly debt per se, and therefore wouldn't concern me as much. When you're looking at the other piece in the balance sheet, which somewhat concerns me, it's the trade payables number. The trade payables number has gone up from 150 crore to 200 crore, but at the same time, that is also healthy from a cash flow perspective. Whether this sustains or not is a question, but nothing major or significant per se, because you'll likely see these payables either unwind, or either it means that the companies supplying to Dhanuka are comfortable with the kind of trade payable number over there. There's very low debt per se. It's a 5,800 crore market cap company with just 57 crore of debt, and that too largely to fund the acquisition which they've made. They made a 165 crore acquisition from Bayer. So a lot of this debt is to fund that acquisition. Otherwise too, historically, they've never taken on debt. The debt has never gone above 40 crore in the last 12 years when I'm looking at each of the financial years. So therefore, just goes on to show that they like to keep it light in terms of debt, and therefore the thumbs up on the balance sheet. Varsha, you want to take us through cash flow?
Yes. So we would give a neutral, stand when it comes to cash flow. Now let's just analyze it. So if you see so I'll start with March 21, that is FY21. Therein the cash flow from operating activity was around 231 crores. Fast forward to FY24, it's 134 crores. Now why this gap? One is in FY21 there were no receivables. Very less receivables versus in FY24. If you see the receivables, that is around in FY23 it was 58 crore and in FY24 it was 9 crore. So money was stuck in receivables when it comes to 23 and 24, while in 21 there was no money which was stuck in receivable, number one. Number two, if you see inventory, so the cash was also stuck in inventory when it comes to March 24, that is 73 crore. Rupees 73 crores is stuck in inventory, while in FY21 if you see only 46 crores were stuck in inventory. So these are the major reasons why you're seeing this gap when it comes to cash flow from operations. Now if I want to talk about cash flow from investing in FY21, they did a lot of capex, and this is the reason you are seeing 127 crore outgo when it comes to investing activities, and in FY24 there's only 81 crore. And of course their Dahej plant, if you see, they already did a good amount of capex, and now maybe going forward we won't see that much of investing activity unless for Dhanuka. Of course after a year or two we may see that they may go for future capex when it comes to Dahej and of course the other capex. But now overall if you see, now we won't be seeing any much investing activity that a company would go to. But overall if you see net cash flow, there is only 3 crores of change versus 25 crores of change in FY21 because of that higher investing activity that the company did. So overall I would say a neutral kind of stance that we would give, because Harsh, this is a growth phase company, right? So you need to give a kind of what do you say, that some leeway.
Correct.
That because considering the growth phase that they are gonna invest when it comes to investing activities. So I don't think so that we.
And it's also a tough phase you mentioned, Varsha.
Exactly.
When you spoke about the agrochem sector, when we contextualized it by speaking about UPL, it's also a tough phase, and therefore we'll have to give a little bit of leeway to the company, and we've done that. We've given it a neutral on the cash flow count. Let's talk about how the return ratios are lining up, and when we're looking at the return ratios overall, there you go, very healthy in terms of ROC. Not too many companies clock this kind of a return ratio, anything between 25 to 30%. And it's gone above that as well, but it's not come significantly below that in the cycles that we've seen over the last 10 to 15 years. Even ROE numbers fairly healthy. They've stayed above the 20% number. So on both of these counts, very little to complain about from a shareholder perspective. The reinvested cash is being dealt with in a fairly sensible fashion. Capital allocation seems to be on point.
Also, Harsh,
yes,
now
please.
just we're speaking on return ratios. If you see the ROCE of PI Industries, that ranges about what, 22%.
Sure.
So as compared to PI, pretty good number when it comes to Dhanuka. Even
Correct.
if I were to talk about Sumitomo Chemicals,
Correct.
so they're in line with their peers when it comes to return ratios. So good.
And this is despite the Dahej facility not
Yes.
doing very well in terms of capacity utilization.
Yes.
So capacity utilization is important when you're looking at capital, because that's the capital you have put in a facility, and it will only get better if the facility optimizes itself. And therefore, the fact that there is scope for the Dahej facility to better itself in terms of optimization leaves some room for upside, if not downside, for ROC numbers and ROE numbers.
Exactly.
So on that count, definitely a positive. But Varsha, back to you.
So I would actually speak about shareholding pattern.
Yes.
Let's see how that looks. So when it comes to promoters, 70% of stake is held by promoters. Now this is a very good news, skin in the game that we talk about. So that shows the confidence of promoter in their company. So in that sense, it's very good. If you see FIIs, though it has come off little bit, but that's not an alarming sign. Maybe because of the agrochemical pressure, FIIs have, pulled out money from them. But if you see DIIs have increased their stake by mere 1%, and public shareholding have remained the same. But overall, this is actually not a bad thing. It's a very good thing considering 70%, and FIIs, considering the pressure that the industry is going through, having 2.16% of FIIs it's not a bad thing.
Absolutely. Let's also look at street cred, and this has moved a bit because the stock is up nearly 5% in trade today. So I want to quickly look at street cred. Now, in terms of the way the stock has moved, it's down just about 15% in the last 6 months, not 19% because of the 4% move today. You're also seeing the last 1 year move at 19% up, given the move today, maybe 24-25% higher on a 1 year basis. But the last 5 years, it's been nearly a 3.5 bagger, which is a positive. But when we've seen how some of the small and mid caps have moved, it's largely been in line, and therefore we'll give this a neutral and not go overboard by giving this a thumbs up. But Varsha, in terms of guidance and future outlook.
Yes, so this is actually very important because we need to see what is companies going to do when it comes to future outlook. So one is they're expecting 15% growth when it comes to sale. Now this is a standalone. Company is also expecting the buyers acquisition that they did. So so this is except that 15% growth is except that buyers acquisition that they did. So we can assume 18 to 20% of growth in FY25 and 26 what the company will do. And they're also aiming revenue growth of 10 to 15% for acquired products in next few years. Gross margin is expected to remain stable at around 38 to 39%. I don't think so they would go more than 40% because in this quarter they did around 39 to 40%, which was best in last 5 years. So they're not expecting increase in gross margin, number one. Talking about the international expansion, so they're planning to expand over 20 countries, and also they're also leveraging their Dahej facility, which will actually help company to grow their top line, maybe in FY26 and 27. So overall, Harsh, I would say also in Q4. So Q4 they're expecting actually very good numbers when it comes to 14% of revenue growth in Q4 year on year, plus 100 basis point of margin increase. That's what they said in con call. At least we need to check if they are actually maintaining their guidance. So this is actually a very good thing, but 100 basis points is not that. It's great for a company like Dhanuka.
Sure. Sure. What about valuations? Because you've done a little bit of a breakdown on that count as well.
So if I were to talk about the TTM, that is trailing 12 months PE. So if you see Dhanuka Agritech is trading at around 20-21 PE. If PI Industries at 30, Sumitomo at 54. So on trailing basis, of course, Dhanuka is looking, very cheap. But you also have to take into account that PI Industries has a custom synthesis business which has a higher margin, and PI Industries cater to global clients, to innovator companies. So overall, this is one of the reasons that PI Industry has got that premium valuation as compared to other agrochemical companies, though the valuation has tapered off because of their lower guidance that the company did. But of course, in next 2 to 3 years, PI Industries will also be back with their solid numbers. One is that. But talking about FY26, very forward PE basis FY26. Now we did some calculation considering 18 to 20% growth in Dhanuka. So and also taking almost 12.9% of net profit margin. The forward PE of Dhanuka comes at around 15. While PI Industries and Sumitomo Chemical, if you see the forward PE of PI Industries is 27, followed by and Sumitomo Chemicals is 43. Now this is according to Bloomberg data. Overall, if you see again, considering the growth prospects that the company has, considering the acquisition that the company is doing, of course, Dhanuka is looking, at cheap. But as I said, PI Industry has some kind of, advantage. Also, Sumitomo Chemicals have advantage over Dhanuka.
Sure. Now let's quickly sum up and give it a KYC rating, right? Income statement is the only one where we've given it a thumbs down. Other than that, we've seen fairly decent-ish in terms of the parameters and how they fired. Whether that income statement can do better in terms of top line will be the big question. Shareholding positive, street cred neutral, outlook neutral, valuation picture positive because, of course, Varsha did take us through that. 5.5 on 8 is our KYC rating. Let's quickly, though, go across, speak with Mr. MK Dhanuka, the chairman at Dhanuka Agritech. Welcome, sir. Good morning. Thanks for coming and speaking with us. First off, I want to try and understand. You've guided for a 15% top line growth. You've made a new acquisition. This gives you scope to expand in different geographies. And you also have capacity available. Do you believe that there is some possible upside to this guidance? Do you believe that?
Yeah, definitely 15% growth we are expecting from our existing business, and the acquisition of 2 products from Bayer, that will be additional. The Indian sales will come in the financial year FY26 in Dhanuka books. But the overseas sales of the iprovalicarb and the other molecule, once the registration are transferred in Dhanuka's name, then the revenue will reflect in Dhanuka's books later on.
Hello, sir. This is Varsha joining in. I just wanted to understand the overall industry scenario because we all know that chemical and especially agrochemical have been going through a lot of pricing pressure because of destocking and all that. So how are we, because we are sitting on in March, how has the industry been right now? Any signs of improvement that you're seeing?
Yeah, till January, definitely the prices were on downwards trends, but from February onwards, the prices have started moving forward, and there is improvement in the prices of most of the technical grade pesticides. Although the prices are more or less stable, but because Chinese season has also started right now, so their demand is also picking up in China itself. So overall, the prices in India, because of the dollar improving, that has also been a factor in increasing the prices. And in last 2 years, the technical manufacturers were either doing business at par or even in losses. So you will see that the brand sales company were performing better in comparison to the technical manufacturers companies. So now the technical manufacturers is in the mood to not to basically outgo from their pocket, and they are increasing the prices, and the companies are gearing up for the Kharif season. So demand is also picking up. So demand and supply rules the prices, and because demand is picking up, the prices are also for many molecules have improved in the month of March.
Note, sir. So I remember that you had mentioned that you'll have 14% of revenue growth when it comes to Q4 with expansion of EBITDA margin by 100 basis points. Are you on track?
Yeah, we are on the track, and we hope that when the March 25 results will be published, we will be meeting our guidance.
Point taken. Mr. Dhanuka, I want to try and understand what the US exposure looks like and what the upside in terms of export opportunity looks like. Give us that perspective. One is, of course, the US market and what could happen in terms of tariffs, but also the overall export environment, given this Bayer acquisition. What does it open up for you on the existing product pipeline front?
Frankly, you know that till last year, Dhanuka was purely a domestic company.
Yes.
Only from last year onwards, we have started exports, and we are at a very niche stage in the export segment. Even the Bayer's product which we have acquired, that is not being registered in US, that is mainly in European and Asian countries. So the major business will come from the European market and the East Asian market. So we don't expect that the US tariffs will have any impact on Dhanuka business, but definitely if the US impose tariff on the imports of technical grade pesticides from India, then that can have some impact. But as they are putting up more tariffs on China in comparison to India, I don't think that India will not be economical in comparison to China even in times to come.
Point taken. Sir, you're currently at around 2,000 crore in terms of top line. When I'm looking at trailing 12 months, where do you seek to go? Another 220 odd crore likely in terms of the acquisition you've made, which will also grow at 15%. So therefore, where should that take your top line, and is 20% the right margin to look at from a slightly medium to long-term perspective?
Once the total business of Bayer for both the molecules comes in Dhanuka's revenues total, then definitely we will like to reach to 2,500 crore. But till the Bayer's product doesn't come.
So how quickly do you get to 2,500 crore? Apologies for interrupting. How quickly do you get there?
In 1 year time.
Okay, so maybe FY26, is that the aspiration?
No, but as I told you, only India business will come in Dhanuka's books for Bayer. So that will be 2%. So overall, we are expecting around 17%. Consider around 2,000 crore business this year. So we will be around 2,300 crores in next year.
Understood. At a 20% margin. And thereafter, sir, what's the visibility like? 15%? Maybe for the next 2 to 3 years at least?
Sir, you know the agriculture and agrochemical business depend mainly on monsoon. Monsoon is good. Definitely, we expect that we will be able to grow by 15%. But if monsoon is weak, then the growth may be impacted because of that.
Point taken. Thank you so much, sir. Apologies, we are short on time, but thank you so much for coming in, speaking with us. Well, that's the management of Dhanuka Agritech talking to us about what the prospects could be over the next 2 to 3 years. Subject to monsoons, 15% is the aspiration on the 2,500 crore top line of FY26 is what they are guiding for with a 20% margin. Anyway, believe we are out of time on this one. From Varsha, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.